Hi, and thank you for joining us for our third quarter market and economic update. I'm Jason Gunkel, head of the investment team here at Syverson Strege. I can bring you some good news again this quarter that the market rally has continued. U.S. stocks continue to rebound from their drop earlier in the year, with the S&P 500 up about 8% for the quarter and close to 15% year to date. International stocks continue to lead the markets this year, with the MSCI EAFE index up over 24% year to date. On the fixed income side, U.S. taxable bonds have returned 6% year to date as their prices have been boosted by a drop in interest rates. And municipal bonds also rallied this quarter and are up about 4% year to date, providing some attractive returns for investors in higher tax brackets. Two of the biggest developments this quarter were the passage of the new tax bill and the Federal Reserve's move to lower interest rates. The tax bill injected fiscal stimulus into the economy and reduced certain tax burdens for both individuals and corporations. While it offers tax benefits, it also adds to concerns about federal deficits and long-term debt levels, which markets are watching with caution. The Fed's interest rate cut of 0.25%, its first of the year, was driven largely by signs of slowing job growth over the last few months and the unemployment rate rising to its highest point since 2021. At the same time, the Fed has made it clear that inflation remains a concern, as do the potential inflationary effects of tariffs. The inflation rate has risen since April and is now close to 3% again. So while the labor market softening helped justify cutting rates, rising inflation is lowering some expectations for future rate cuts. The median expectation among the Fed's committee members is that 2 more rate cuts will happen this year, followed by only 1 rate cut in 2026 and 1 more cut in 2027. Shorter-term U.S. rates tend to be more directly influenced by the Fed's actions. After the Fed's announcement, short-term rates eased somewhat, but longer-term rates, including those affecting mortgages and longer-term borrowing, have been more stubborn. These longer-term rates are much more subject to what investors think inflation will do in the future. Therefore, we are preferring to hold short to intermediate-term bonds, which tend to do better following rate cuts, while the returns of long-term bonds can be much more uncertain. The weakening of the U.S. dollar has provided a big boost for international stock returns this year. Because a weaker dollar increases the competitiveness of U.S. exporting companies and boosts returns for U.S. investors in non-U.S. assets, that trend has given international equity markets an extra tailwind. The facts that many international stocks look cheaper relative to U.S. peers, and there are some improving economic conditions outside the U.S., has helped international stocks lead the way this year. Turning back to U.S. markets, the S&P 500 stock index is heavily concentrated in a few of the largest stocks, sometimes called the Magnificent Seven. You need to go back to the early 1970s for the last time that the top 10 stocks made up more than 30% of the index. That concentration means that the overall market performance depends heavily on the success of a handful of companies. The last 2 years, the Magnificent Seven has done extremely well, but this year their performance has been very mixed and much more in line with the rest of the market. We want to make sure that our clients are not over-concentrated in these companies and their portfolios are more diversified. Companies continue to have high expectations for their earnings, with analysts predicting earnings growth close to 11% in 2025 for the S&P 500, according to FactSet. At the same time, we also note price-to-earnings ratios across many sectors remain elevated, suggesting that much more of the market's future upside is already priced in. So for the market to continue to move up, companies will largely need to meet or beat these high expectations. In summary, there are positives in the economy that could keep the market moving up, including the Fed continuing to cut rates, a fiscal policy that is supportive, and international markets offering attractive value that could get additional support from the US dollar continuing to drop. But there are also risks that remain, including inflation creeping back in, slowing job growth, and the possibility that company earnings miss expectations. As a result, we are tilting toward high-quality companies that are less expensive from a price-to-earnings perspective. We can continue to favor shorter and intermediate-term fixed income over long-term maturities, and we continue to emphasize diversification with exposure to both U.S. and international stocks and bonds without being too concentrated in a handful of companies. Thank you again for your continued trust in us. We appreciate the opportunity to serve you, and we will continue to monitor the markets and look out for your best interest. Take care.